Inflation is a term we often hear, but what does it really mean? At its core, inflation refers to the general increase in prices of goods and services over time. Imagine you could buy a candy bar for $1 last year, but this year, that same candy bar costs $1.10. That 10-cent increase is a small example of inflation at work. Now, why does inflation happen? There are a few key factors. One major reason is the increase in demand for goods and services. When more people want to buy something, businesses can raise their prices. Think about a popular concert. If everyone wants to go, ticket prices go up. This is known as demand pull inflation. Another factor is the cost of production. If it becomes more expensive for companies to make products, due to higher wages or increased prices for raw materials, they often pass those costs on to consumers. This is called cost push inflation. For instance, if the price of oil rises, it costs more to transport goods, leading to higher prices at the store. Inflation can also be influenced by government policies. When a government decides to print more money, it can lead to inflation. More money in circulation means that people have more to spend, which can drive up demand and consequently prices. However, if the amount of goods and services doesn't increase at the same rate, inflation can spiral out of control. Now, not all inflation is bad. A moderate level of inflation is often seen as a sign of a growing economy. It encourages people to spend and invest rather than hoard cash, which can stimulate economic activity. Central banks, like the Federal Reserve in the United States, often aim for a target inflation rate of around 2% per year. This level is considered healthy for economic growth. However, when inflation rises too quickly, it can create problems. If prices increase faster than wages, people can find it harder to afford everyday necessities. This is particularly tough for those on fixed incomes, like retirees, who may struggle to keep up with rising costs. High inflation can also lead to uncertainty in the economy, making it difficult for businesses to plan for the future. So, how do we measure inflation? The most common way is through the Consumer Price Index, or CPI. The CPI tracks the prices of a basket of goods and services that a typical household might buy, such as food, clothing, and housing. By comparing the CPI over time, we can see how much prices have increased and therefore how much inflation has occurred. It's also important to understand the concept of hyperinflation. This is an extreme form of inflation where prices rise uncontrollably, often leading to a collapse of the currency. Historical examples include Germany in the 1920s and Zimbabwe in the late 2000s. In these cases, people found it difficult to buy even basic necessities, as prices changed dramatically from one day to the next. In conclusion, inflation is a complex but essential part of our economy. It affects how we spend, save, and invest our money. Understanding inflation helps us make informed decisions about our finances and prepares us for the economic changes that come our way. By keeping an eye on inflation rates and understanding its causes, we can better navigate our financial futures.